Hi guys, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling international author of Australian Real Estate Investing Made Simple. Welcome to today's property market update, January 2024. My God, has time flown by. Before we get into the data and everything, I just want to say a couple of things. I've got a bit of hay fever, so I'll be coughing and sneezing, possibly crying throughout this presentation. I can't help it. I'm European. I wasn't born here, and the pollen is very harsh in this environment, especially with my garden. The gardens we're in today doing the hedging, and there's pollen in the air. I've got wattle trees. I've got everything pollinating. It's a bit crazy at the moment. Uh, Also, I want to apologize for leaving it so long between videos. I was kind of, look, I was just lazy. There's no excuse. I was just enjoying having holidays and floating in the pool and drinking Coronas and doing powerlifting from time to time. Really, there is no excuse. But I also wanted to wait for CoreLogic RP data, as they used to be called, to get all the data from 2023. So I was wanting to get all the December quarter data finalized so I can really pick apart the market and what happened in the property market, specifically in Melbourne in 2023. And I was also waiting for the RBA and the ATO to come back with tax figures and the inflation figures so I could correlate everything together, give you a really concise summary of what's happening in the Melbourne property market. But more importantly, how last year will be influencing this year, and also what's going to happen this year in Melbourne property market, next year, the year after, in terms of macro level, big picture kind of stuff. So it's a very good kind of a concise summary, and I'm hoping to give you a bit of nuggets and wisdom so you can use that to make money and have a very successful 2024. So sit back, relax, grab a coffee and some protein bars, and let's get into it. Now, before we get go any further, I just want to give you a bit of background. By the way, disclaimer, I'm not here to make you wealthy or to promise or imply in any way, shape, or form that anything that I'll be covering during this presentation is going to make you any money. This is not deemed as financial advice. It's just a bunch of stuff that's working for me and other investors. I will guarantee one thing though, if you don't take any action, guys, you're going to end up dead broke at 65, asset rich, one house paid off, and 100 or 150,000 in your super, which is where majority of Australians are ending up these days. So inaction is as consequential as taking the wrong action. So you have nothing to lose basically. By getting informed, getting your financial literacy up as high as possible, and getting educated on what's happening in the Melbourne property market and in the Australian property market. A little bit of myself. Um, I wasted 4 years at Monash University, playing pool at the tavern and drinking beer and doing assignments with international students, which was interesting. Then I went into financial planning. I worked for a company called Australian Uni Funds Management, and then I I left financial planning, kind of disappointed and disillusioned with the whole industry, really, because really they weren't making any people wealthy. They were just selling a bunch of financial services and insurance products. Got into mortgages, residential, then commercial with NAB. Then eventually I was a private banker for NAB, working in a company called Medfin, which is a subsidiary of NAB, specializing in medical finance. I was setting up medical clinics, dental clinics around Melbourne. The reason I'm telling you all this is not to bore you to death with my career, is because I had the privilege of working with some of the smartest financiers in NAB in Victoria, and also I had the privilege of working with investors who had massive property portfolios. So I took all that methodology, implemented myself, and as a result, I've built a multi-million-dollar property portfolio myself, and I'm helping others to do the same. So all the stuff in my book, on my YouTube channel, all the things I talk about finance, none of it is really mine. I've just borrowed it from people that are smarter than me, but I'll take the credit for it. That's the main part that that counts. Also, it's very humbling, by the way. I want to thank you guys for supporting my book. Both books have hit number one multiple times on Amazon bestsellers, various categories. This is one, for example, where real estate investing is number one under real estate investments, and my finance book is number eight. Here's an example where under investments, my real estate book is number one and finance number four, and under buying and selling homes, my finance book is number one. And this is just ongoing. So I really want to thank you guys for buying my books and supporting me as an author, because when you write a book, you don't know if anyone's going to buy that book apart from your mum, obviously. So it's a very humbling experience to make it number one multiple times. I really want to thank you guys for supporting that. So that's great. And if you want to get a copy yourself, just jump onto realestateMadeSimple.com.au. And also, you can pick up the finance book at any good shop eBay, Amazon, everywhere pretty much. As also a bonus for being here today, and staying for the whole video, I'm going to give you access to a recording of the Real Estate Investing Fast Track Weekend from a couple of years ago, which is worth $597. It's 75% still current because really the big picture stuff hasn't really changed much. So if you watch the recording of the online course and then you listen to my updates on the property market, you pretty much have 100% of the picture, because at my live events, the only difference is that I give you an update on what's happening in the market right now, currently. So, fundamentally, really nothing's changed in the last 10 years. It's pretty much the same suburbs doing the same thing over and over. It's just that there's new people in the market, and the perception is always that something's new, something's different. Remember, the four most dangerous words for property investors is "this time is different." Those words have cost more money to more investors than any other words. This time is not different. You just don't have the level of awareness required to assess the situation correctly. Because I can tell you now, I have the privilege of dealing with some of the most successful developers and builders and investors in Victoria. And I'm talking about people who have massive property portfolios, 30, 40 properties, or they make, they're worth 20, 30, $40 million, 100 million, some of these families that are developing these projects. And I can tell you now, all of them have one thing in common. They are not surprised by what's happening in the market, and they pretty much know what's going to happen in the future without any surprises, and they feel very confident about what's happening. And that's the distinction between the rich and the poor. Because remember, at the bottom of the market, when there's volatility, that's when the greatest opportunity to make money exists. It's not when the market is going up. It's actually when it's volatile. Now, if you don't understand that, that is a problem for you. And then you got to bridge the gap between where you are and where your understanding is, because that's what all these people are doing and taking action, which means when the market goes down, there's the greatest transfer of wealth, and the wealth flows from the uneducated to the educated. So you want to be the educated one, not the uneducated one that sells properties because of the incorrect structuring, or you just couldn't hold on to your assets. So let's get into the Melbourne property market January update. And what an interesting year it's been. The biggest thing about last year, guys, was that majority of the so-called academic experts got it completely wrong in terms of what was going to happen in the year. Embarrassingly wrong. And my prediction is that this year they're going to get things wrong even more so. Because why? Because they're at the bottom, at the end of the day, a broke person can't teach you how to become wealthy. That's the reality of the situation. So if we look at December quarter numbers, and this is for Melbourne, at the national level, for the month of December, Australia national, this is combined regional centres and major capital cities, 0.4%. For the quarter, 1.5%. Annually, 8.1% for the entire country. So where's the crash that I was promised? Where are the tsunamis that we were promised during the COVID-19? Do you remember how people were saying there's going to be a tsunami of insolvencies? There's going to be a tsunami of business bankruptcies. There's going to be a tsunami of people expiring, where their loans are maturing from a 3 or 2 year fixed rate and rolling over from 3% to 6%. What happened to those tsunamis? Why hasn't there been any correction in the property market? And nationally, we did 8.1%, 12.1% if you factor in rental yields. In fact, Sydney did 14.3 combined. If you look at just without rental yields, 11.1. Melbourne 3.5, because Melbourne's at the bottom of the property cycle, about to go up. And then Brisbane's 13.1. Adelaide, no one cares. Let's face it, no one cares. And then Perth 15.2. In terms of the actual data, and I'm not here to teach you economics or go through data for the sake of going through data. I actually want to give you kind of nuggets of wisdom about how to interpret the data and how to use that to make money. Because I'm not here to teach you economics, guys, or housing, solve housing issues in Australia. I'm purely an investor. This whole channel is just designed to give you knowledge on how to make money. That's it, So I'm not going to go through every piece of graph and data and explain the fundamentals behind the numbers, but I want to just show you a couple of things. The whole market is based on 3 months. It's not, you can't look at the market weekly or even monthly, because even an established property takes 60 to 90 days to settle. And remember, agents are very lazy in giving the information back to the various data, gathering, I guess, companies like RP Data and CoreLogic and Residex, who capture that data or domain, for example, realestate.com, and then translate that data. So really, weekly stats are really, apart from auction clearance rates, which kind of gives you the pulse of the market, weekly stats are kind of irrelevant. We're looking at quarterly movements. This whole market's very slow to move, and everything takes a long time to do. So if we're looking and it's got a very cyclical nature as well. And each market, it has independent markets within that market. So we have Melbourne, for example, which is its own property cycle, which is kind of 16 to 2 years, 16 months or 2 years behind the Sydney property market. And remember, 80% of the whole market is Sydney and Melbourne, which is where all the money is. The rest of the market's only 20% or thereabouts. So it's not really important to focus on small markets. Having said that, you can make money in regional towns. You can make money anywhere, but depending on your level of knowledge and skill. So don't think you have to be in a major capital city to become a successful property investor. I know investors, whether in little regional towns of 15,000 people, they've made a killing because they're on the board of the council. They know exactly what's happening with rezoning in the area. They know what's happening where the petrol station is getting built, McDonald's, hotels, rezoning from residential to commercial. So it's not about how big the area is that you're investing in. It's your level of knowledge and awareness will determine your outcome and how much money you make. Remember, there's no market risks, guys. You're the risk. You're the risk. The market has no risk. And if you think the market has risk, you've got to educate yourself to a level where you start believing that it has no risk. The biggest risk is you and your lack of knowledge. That's the reality. So I don't agree with half the stuff that I learned in my financial planning diploma when I did it 25 years ago. I think most of it is completely outdated and theoretical. So if you look at the 3-month average, this is for combined capital cities. And now, combining capital cities and regional towns, is it really, apart from being mathematically correct, can I really get something out of this? And the answer is no. It's not even a finger on the pulse of the market because the markets are so different from each other, especially if you go to Darwin, Northern Territory, all those kind of markets, WA, and trying to cluster them together with Sydney, Melbourne. I mean, I don't understand what the point of that is, apart from just graphing some data. So really, if you look at combined capitals and regionals, you got to split them apart and you got to go more micro level before you can look at some discerning data. Definitely, like if you look at state by state, this is 3 months rolling average. Perth 5.1, Adelaide 3.7, Brisbane 3.7. See, Adelaide, I mentioned you. Don't send me emails. Sydney 0.8 and Melbourne negative 0.2. It gives you kind of the direction of where the market's going because of its cyclical nature. And that's it pretty much. So if you compare every quarter, you can see the direction where the market's going up or down. Now, remember, within each market, you can have a market that's going down, but there's suburbs that are doing double-digit growth in that market. And we see that in Melbourne and Sydney all the time. And at the same time, we have a market that's booming and you see suburbs that are actually losing money or going sideways. Remember, you can't invest in the property index, guys. You've got to invest in a specific street and a specific property or house or apartment or townhouse. So these kind of generalized data only gives you kind of a feeling of what's happening in the consumer sentiment in their mind. Beyond that, it has no real application to us as investors. Annual change, yeah, sure. I mean, it's interesting. You can see how it goes up and down from 2018 to 23. So Melbourne, this is for rents, 11.3, Perth 12.9, Sydney 9.2, Adelaide, no one cares. Brisbane 6.7, and Darwin 3.1. Melbourne has done really well with rents. And remember, Melbourne's 8 distinctive markets. There are suburbs in Melbourne, like the Bayside, the eastern suburbs, where some of the properties that I've been sourcing, the rents have gone up by 20 to 30% in the last 12 months, 24 months alone. We've never seen that before. There is a ridiculous critical rental shortage in Melbourne right now, and vacancy rates in some key areas are 0.7, 0.6%. Just so you know, the average vacancy rate should be 4.5%, which means you open up in suburb like Cheltenham and there should be 60 to 90 properties on the market for rent, not 5, So we're getting to a stage now where it's sheer desperation and the government has no solution and they'll never solve the housing issue. And in fact, everything they do has the opposite desired effect on the property market. The best thing the government can do, especially the Labor government, just stay the hell out of the whole market as well. Not even mention the market. Just keep doing what you're doing without getting involved in the market. Rents, this is annual rents change. So you can see the Perth 16.5, Brisbane 13.0, Sydney 11.7, 10.8 for Melbourne. Now remember, inflation is tracking now at 4.1. It was tracking around 6-7% for the year. So that's really good. because if you're getting an 11% increase in rental yields, remember any increases in interest rates, this will counter affect that. So a lot of people are kind of sitting back now going, oh, interest rates are very high. I'm struggling with my mortgage. I don't want to get into the property market. That's a really bad decision because if you bought 2 years ago, that property potentially now would be cash flow positive, which means number one, it would give you money towards your current mortgage. Number two, just the negative gearing aspect of property. If you purchase in your own name, you on an average property of let's say 700,000, 800,000, and if you're an average income earner of say 120, you'd be probably getting 15, 20 grand back in taxes every year from the ATO. So, you could be looking at 20, $30,000 per year difference right now if you bought 2, 3 years ago in correctly the right suburb for the right price. So, the thing about it is, if you're going to be waiting for this magical moment where everything's perfect, you're going to be buying one property every 20 years. And then if you don't have the skill sets to actually understand what's good value, then you're going to be buying the wrong property. So this is the kind of attitude that people have. I want to wait for everything's perfect with them. I've got buffers in place. Guys, that's the wrong psychology. If you're serious about investing, you've got to get into a place where you're consistently buying and as much as you can, as often as you can, really. I mean, depending on your strategy, but also because you've got to understand the longer you wait, the more you pay for the same product in the future. And also, interest rates, whether they go down, which they will in the future, has no bearing on capital growth. Capital growth will continue on, and I'll cover why. This is the actual CoreLogic Home Value Index. So you can see there, this is for the quarter for the year. And annual is what we want to do. So if we look at, for example, Sydney, it's 11.1. And then you have total return, including rental yields, which is as well. So, Melbourne's annual 3.5, Brisbane 13.1, and then LA 8.8, Perth 15.2. See, Adelaide, I'm mentioning you. Why is Melbourne only 3.5? Because the other ones, Sydney and Brisbane, have boomed already, and Melbourne's at the bottom. I'll show you where about to go up into the next phase of the property cycle. If we step back a little bit, and I often talk about this as probably the most important part of understanding numbers. And I've mentioned this many times in my live events and on the various YouTube videos. The Australian residential property market is worth $10.3 trillion, right? Let's say it's 10 trillion, okay? Let's say it's just for the ease of number crunching. We've only got 2.2 trillion outstanding mortgage debt. So the loan to value ratio is we have 22% gearing in our property market. So imagine you've got a house for $1 million and you've got a mortgage for 220,000. Are you concerned? Are you stressed? So when these experts from America come over, like Harry Dent, and they start talking about the market collapsing, why would the market collapse if you only got $220,000 in mortgages and you get the rest in equity, which you can draw out up to 70% without any issues? And remember, the culture in Australia is that we will defer holidays, clothing, new cars, everything, and the house will be the last thing that will go. We'll hold on to the house no matter what. So this market's not going anywhere. It's just going to go sideways and up and sideways and up. If you're thinking that there's going to be a massive correction in major capital cities, you're going to be wishing for that to happen. You're going to be waiting for the rest of your life, and it will never happen. It's just we haven't got the industry in Australia to consistently flood the market with stock. The only thing that could happen, and this is why I talk about this all the time, if we stop migration and we keep building, and there's going to be an oversupply in prime areas, which is virtually impossible, then yeah, the market will have a correction, definitely. There's no question about it. The reality is the bureaucracy that is associated with getting permits to develop anything in the top 1,000 suburbs in Australia is so extreme. And I deal with this every day with developers. I mean, developing in Elwood, St Kilda, Brighton, forget it. It's a shit fight all the way. You're fighting all the neighbours, everyone. No one can just create new supply, in Essendon or in Williamstown or in St Kilda. Every project is months and months and VCAT and fighting everyone. So this notion that these markets will be flooded and that's the only way you can devalue something is just baloney. And who wants to live close to city on the water in a safe area with lots of rich, happy people? I don't know. Yeah. Like that's going to change, So just wishful thinking, guys. So you just got to understand this $10 trillion market, 220 trillion in mortgages. And those mortgages, because 70% are owner-occupied properties, they're never leaving the market. So no one's going to sell a house and buy a car or go back to renting. We're going to sell one house and upgrade our house. This market's not going to correct significantly, not in a way where you can make huge amounts of money. And remember, 56.7% of our national wealth is locked up in the residential property market. This market's too big to fail. And if it does fail, it doesn't matter if you got property or not, because the whole economy will collapse, the currency will collapse, the banking system will collapse. So it doesn't matter if you're renting, not renting, you're in the same situation. Okay. But it won't fail because no one will make money if it fails. The banks will, it's no one's interest for it to fail. And the banks and the government and the valuers and the entire financial services sector are propping up the market and manipulating the market in a way to make sure that it will never fail and to make sure that never enough supply is created in the key areas. I'm not talking about house and land estates or apartments. I'm talking about blue chip areas in Melbourne, Sydney, and Brisbane. Commercial real estate's 1.3 trillion, which is virtually nothing, and the ASX is only 2.9 trillion. So the ASX is a third of the residential real estate market. This is like the biggest thing we have in Australia, and that's why it's in no one's interest for it to fail, especially owner occupiers. In terms of the average, if you look at the national values, 1.5% growth for 3 months. 12 months, 8.1, which is really healthy, guys. 8.1 is a perfect market. It's not overheated. It's not cool. I know this is combined for major capital cities and regionals, but that's a really healthy figure. And capital cities 1.5. If we look at 3 months changes in dwelling values, you can see that Melbourne's 0.2%. And that's because there's a lot of suburbs in Melbourne, especially the top 50 highest, most expensive suburbs, where if people are not getting the right price for their house, they pull them off the market. So the most expensive suburbs in Melbourne have up to 40% less stock, even 50%, compared to the norm before COVID. Because think about it. Let's say you're in Toorak, you got a $15 million house and you're not in a hurry, it's paid off, right? You're super wealthy, you're super relaxed, okay? And by the way, 15 for Sydney people is nothing. Now, agents are saying to you, you know what, you can't get 15, you're going to get 10, 12. Well, you're not going to sell unless your business is in trouble or you need money. So what you do is you pull the property off the market. And this is what's been happening for the last 3 years. The best houses in the best suburbs in Melbourne, Brighton, Toorak, Hawthorn, Kew, all those areas, everyone's taken everything off the market. And because they're not getting the prices that they want. And that's why the volume has actually been reduced by 40, 50%. And that's why the median price moves to the left, which is 0.2% movement. So it's not so much that we've actually lost or devalued with 0.2% of the market. It's because when the volume shrinks, the middle property shifts into the direction of the cheaper properties. Okay, so that's all that happens, guys. And remember, the median price is not a good way of calculating the market. It's just the middle property sold in one market compared to the middle property sold in another market. That's all it is. So it's just the one way of calculating what the market's doing. Rolling quality average in dwelling values. So you can see the major capital cities, and then we've got combined regionals. Like I mentioned before, there's no point looking at that data really. It has no real application. Capital cities, it's all cyclical, and we're going to go through. I like to really unpack capital cities into the 25th, 50th, and 75th percentile. So these are property based on, if you understand the standard deviation, go back to year 9, there's a bell-shaped curve for every occurrence. And if you map out properties based on price, you got 25th is the cheapest percentile. So it's 25 of the bottom of the cheapest properties. Then you got the 50th percentile, which is kind of the middle, and the 75% percentile is the more expensive properties. And remember, with every property cycle, it's first the big mansions that start driving the market, then the middle market gets in, and then the cheapest properties get dragged up by the market. Okay, so if you look at like Brisbane, Adelaide, and Perth, they've already peaked because the market's higher. If you look at Melbourne and Sydney, for example, you can see it's down. It's very low, 0.2, 0.3, and negative 0.8, which means people have taken mansions off the market in Melbourne. The middle is just going sideways. Same with the cheapest properties. So is it a good time to buy? Look, it's always a good time to buy property. The problem is at the moment in Melbourne, there is nothing exciting on the market. And I look at my favorite suburbs when I've got nothing to do. And really, the best properties in terms of location, I'm talking about like Toorak, Brighton, Hawthorn, Kew, Canterbury, Camberwell, Essendon, all those areas. The best properties are not on the market at the moment. They've taken them off. There's no waterfront properties. there's nothing really special in the market because those people choose when to sell and when to buy. Housing cycles, this is a 28-day rolling average according to CoreLogic Daily Value Index. So this kind of gives you, I guess from January to January, it gives you kind of the worm, as we call it, in terms of where the property market's going. It kind of gives you the pulse of what people are thinking. Because remember, when people are more confident, they'll sell properties and update and upgrade. They'll update their cars, white goods, and they'll buy houses. When people are not confident and they don't know what's happening in the world, with there's wars, economic challenges, they tend to hold back with things and build up saving buffers. And we saw that during the COVID-19 pandemic, where we had the biggest buffers built up over a period of time. People were 9 to 12 months in front of their mortgage. People were concerned. They weren't going for holidays because we were, trapped in lockdown thanks to dictator Dan. So we weren't spending money. We couldn't go out and eat. We couldn't go to restaurants, couldn't do anything. So we were just watching Netflix, getting Uber deliveries, and then just saving money. And we've built up that buffer now since then because interest rates went up 13 times in 14 months. We've nearly wasted about 3/4 of those savings back into mortgages. But the light is around the corner, which is good. So it's not going to last very long. And so here what we see is the rolling 28-day average growth rate in CoreLogic Daily Volume Index, which gives you kind of the all-encompassing pulse for the nation. I mean, this groups together all the major capital cities. Really, from the practical perspective, there's no application of this information apart from getting an idea of where Australia is. But what is Australia? I mean, you got WA, which is so mining reliant, and then you got Sydney, which is completely mining non-reliant, where the majority of the growth occurs from the financial services sector. So really just gives you a bit of an understanding. We've got to unpack this further and look at it state by state level. So in Sydney, you can see that in December, the growth was 0.2%. And then the quarterly growth was 0.8, over the year 11.1. So Sydney was slowing down, did a U-turn in December 22, and then it came back up through most of 23, and then it's kind of turning up in December 23, and then it's going even in January now. It's still continued to grow, so it's well and truly past the next phase of the property cycle. And I'll show you where it is on the property clock in a second. Pardon me. Melbourne has done well. Like I said, it's actually behind Sydney around 12, 16 months. So negative 0.3 for December, negative 0.2 for the quarter, 3.5 for the year. You can see there, so we've hit the bottom in December 22, and we're going kind of sideways, more upwards in terms of the median price appreciation. Brisbane is very similar. So it's always Sydney, Melbourne, and Brisbane in terms of the sequence of all the major capital cities. And then we have the others following as well. Sale listings. So this gives you a bit of an understanding of the volume of stock that's on the market. And in the 2023 calendar year, CoreLogic estimates there were 488,898 sales nationally. This is 2.8 lower than in 22. Aside from seasonal drop-off in December, sales volume are trending a little higher than historic 5-year average nationally. And if you look at Melbourne, for example, it's negative 4.2 for volume in December. So and remember, Melbourne's 480 suburbs, so negative 4.2 isn't dispersed, equally throughout every suburb. You have suburbs in Melbourne, especially the established aspirational suburbs like Surrey Hills, Canterbury, Hawthorn, Baldwin, Kew, where there's very low volume of stock on the market. In fact, the stock is 30-40% lower than traditionally. And then you have places like Truganina, Tunheath, Point Cook, Pakenham and Berwick, and your house and land estates, where there's actually a surplus of stock being sold, and there's massive amounts of stock being unsold. I have friends that actually sell house and land estates where they sit there all day in a display suite and they customize house and land estates. And I know people that work at a high level for Metricon, and I know people that work for volume entry-level builders, and they're all struggling massively in selling properties. Their volume of sales is down a lot. And there's a lot of stock where people have overcommitted and now they're financially stressed. So different things are happening in different parts of the market. And in other YouTube videos, I'm going to be unpacking those in more detail. I just can't do it here because here we're just going through the whole update. So we don't have the luxury of time, unfortunately. In terms of days on the market, that's a very important thing, because it gives you the comparison of the previous year and where we were. You can see that as a nation, combined regionals, 41 days to sell an average house, and combined capitals, 27. Usually it's around the 30-day mark. 30-day is like a good estimate of how long it takes to sell a house. So if you look at Melbourne, for example, in December 23, it took 30 days to sell a property. And in December 22, it was 29 days to sell a house. Now, in terms of Australia, you've got 30 days and 31 days. So it's actually accelerating slightly. Regionals 41 for 23 and 36 for 22. So regionals are slowing down because a lot of people that did a tree change and a sea change during COVID-19, they went to regional towns and then they realized that everyone goes to bed at 7:30 and there's no nightlife. So a lot of them came back. Same with seaside changes. I know a lot of people that went to coastal towns during lockdown and it was fantastic. They get up in the morning, go for a run on the beach, except nothing happens after 7:30. Everyone sits at home, watches TV and goes to bed. And if you've been living in Melbourne in places like St Kilda or Collingwood or Fitzroy, and you're used to, going to pubs and bars and beer gardens and hanging out till 3 in the morning, you're going to be in a hell of a shock when you go to a regional town because there's nothing like that. Apart from Bendigo, which is probably the only town that has something, they've got nothing. So a lot of people have come back and now they're back in Melbourne, back in the major capital cities. And that's kind of the reason why regional towns are slowing down. Vendor discounting, it just tells you how much discounts are being offered by vendors, which kind of has to do with, I guess, the level of and look, vendors are always unrealistic about how much they can get for the house. They can always think they can get more than the market. And negative 3.5% for combined capitals and regionals -4, which is not bad. It doesn't mean anything. I mean, I've seen vendor discounting of 10% plus. That's worrying. And this has to do with the level of desperation that people are facing where they have no option but to sell the property because they can't hold on to the property. So you can see that Melbourne, 4.2 for the previous year, and then you've got 3.7 right now. So the vendor discounting is going down, which means that people are paying prices for properties because of the shortage. And so the market is speeding up and going into the next growth phase of the cycle. Auction clearance rates, 70% is pretty healthy. 7 out of 10 houses sell, 3 get passed in. When it's 9, I've seen 9.5 and 9.3 during 2001 and 2 boom. You can't do anything in those markets because everything sells. So it's kind of, you can't negotiate in terms of settlement, you can't negotiate anything. At the same time, during the GFC, when it went down to 4.8 out of 10 or 48%, it's depressing. And then people pull eventually properties off the market. So a good market for me personally is between 70 and 80%, which means 7 to 8 out of houses sell. And there's a good matching principle, which means the market's healthy. And that's kind of what we've been seeing roughly, in the market, especially around Melbourne and especially around the Bayside area. Rentals are completely off the charts, guys. I mean, what's happening in rentals in the major capital cities is just unheard of. It's literally unprecedented completely. I mean, you look at that national 8.3% increase. Now, remember, inflation, and this is one of the reasons why inflation peaked as well. 12 months, 8.1% is unheard of. Combined regionals 4.3 and capitals 9.8. You can see in regional towns there's a lot less ability to increase rentals because people just won't pay those exorbitant prices. But in Melbourne and Sydney and Brisbane, in the top suburbs, especially on the beach, I mean, people are just paying astronomical amounts of money. And the increases are so extreme that I have never seen them before. Even on my properties, I mean, I'm getting the rentals increase so aggressively by property managers. I ring them and I go, "Are you sure this is real? You're going from 900 to 1100, not 900 to 925, 950? No." And they're going, "Listen, the properties across the road just rented for 1100 and yours is slightly, inferior or superior." So yes, it's definitely 100%. People are getting smashed with rentals, and there's a lot of families in the middle class suburbs that are getting priced out of the market for the first time, even in middle class suburbs, and they're going further and further out into cheaper areas with a lot less income demographics. So the further you go out, the cheaper it gets, basically. Um, rental yields are really good, but see, there's an inverse relation between rental yields and capital growth, which is what people don't understand. That not only do we have capital growth cycles, we have rental yield cycles. So, for example, let's say you've got a property that's worth 500,000, and you're getting a $50,000 rental. Okay, that's 10%. Now, I'm not saying that this property exists. I'm just giving you a mathematical example. If the property goes from 500 to a million, and the rent usually get fixed for 12 months at a time, your rent has stayed at 50,000, your rental yield went from 10% to 5%. And then if it goes to 2 million, you went to 2.5. So there's an inverse relationship between capital growth and rental yields. And every suburb also, and every market has different yield cycles, which means that they have a peak and the low point. And so what happens is it really depends on when you get into a suburb, what rental yield you'll have. And also, this is where investors get into trouble. They look at rental yields, and I see all these expert companies where they go, oh, it's got 3.7. I'm looking for higher rental yields. Well, if you bought it 5 years ago, your rental yield would have been 8% in that suburb. Because the longer you hold on to the property, the more increases you have in rents, there's an increase in rental yield because your price is fixed. So number one is don't worry about rental yields, okay? As long as unless you're chasing cash flow. Number two, depending on when you buy in the suburb, will determine what rental yield eventually you're going to get. And the longer you hold on to, the more cash flow you receive from the properties. So making analysis purely as a snapshot on rental yields, for example, saying things like, I need a minimum of 4.5 instead of 3.5. Well, you get 5.5 if you hold on to the property for 2 years because you're going to get two increases in rental yields. So this kind of rental yield psychology where people have these minimum standards, it's not a good way of analyzing the market because you're missing out on a lot of good opportunities. So just bear in mind there's an inverse relation between rental yield cycles and capital growth cycles. And also, every suburb has a unique rental yield cycle. You got to be aware of them when you're buying in that suburb. The best way to find that out is to get reports from RP Data Ecologic or going to property managers in the area and getting reports from them. Generally speaking, if you buy property at any point in time, your rough rental yield in a good area will be around 4%, 4.25. If you're lucky, you'll get slightly more or less depending on which part of the cycle you buy into. You can see that December 23, Australia rental yield is 3.7, regionals 4.4 because they grow slower. There's an increase in rental yields, and then combined capital is 3.5. 3.5 because they've shot up so much in the last couple of years, but normally they kind of equalize at 4.25, and then they kind of find their ground at that level. Dwelling approvals and houses credit. So you can see there, dwelling approvals increased 1.6% in November, driven by a 7.2 increase in more volatile unit segment. Approvals tend to be a little bit higher over 23, but remain relatively low overall. For the past 6 months, monthly dwelling approvals have averaged 13,760 a month, below the decade average of 17,254. So this is the problem with Labor's promise of building all these houses. We haven't got the industry to sustain those promises. We've had over 1,000 developers and builders go bust last year. I'm talking about the financial year. We've got 510,000 migrants coming into the country plus, and we're actually behind the ball of building and creating new stock. And remember, not every suburb has the same volume of stock that's being able to be created. I mean, how many properties can you build in St Kilda per year? I mean, you can't build anything. Just to build an apartment or a townhouse, it's extremely difficult. So you have some of the most desirable suburbs in Australia where there is no volume of stock being built. They have the best school, lowest crime rates, best proximity to infrastructure, city, etc., hospitals, childcare facilities, where people want to live. People don't want to live 60 k's, 100 k's from the city if they have a choice. Okay, everyone wants to live 5 k's from the city on the water. So the problem is, as a nation, we are creating less properties that we need to cater for demand. So we either need to increase our industry, which is virtually impossible, because you've got to create, not only do you have to create staff and labor and people, you've got to actually incentivize private industry and developers to take the risk of developing sites. Because remember, behind every development, there is a person that's risking money. A company is acquiring things based on feasibilities. So you got to have that level of entrepreneurship, and you can't have the government building properties because you've seen what they do. I mean, they can't do anything. They can't run a chick raffle, especially the Labor Party. So we need to, if you want to have lower prices and lower growth in the property market, you need to stop importing 500,000 people into the country, and you've got to gradually sustain housing and then build housing infrastructure and then bring people into the country so you have an equal matching principle. Because at the moment, we are way behind in supplying enough houses compared to how many people are coming into the country. And I don't see the Labor government ever solving this problem. Finance and lending. I'll do another YouTube video just on finance and lending because it is very complex and there's different reasons why people do what they do. But you can see there, investors and owner occupiers. There's been a decline. It's been harder to borrow money because interest rates have gone up 13 times. So people's serviceability has diminished severely, and their maximum borrowing capacity has, in some cases, halved. I mean, we've got clients now with 3 or 4 properties, and I was speaking to Stephen McClutchy the other day, where they can't refinance at all and can't remortgage anything. They technically, no way anyone will touch them because they purchased them at 2.5%, and now the variable rates are 6. Now they're really happy because when they double in value, they'll become millionaires, and then the people that didn't get in, they'll say, "Oh, you were just lucky that you got in." Well, the harder you work, the luckier you get. So I always see these, "Oh, we could never do that again," it's always expensive to buy properties and it's always difficult to buy properties, guys. It's never easy. I've never seen in 25 years' time where it was just so easy to buy property. Because even if you wait for the bottom of the market, what if you can't borrow the money that you want? What if your job or the situation that you're experiencing doesn't enable you to borrow enough money to buy what you want? Or there's nothing on the market with buying. You might wait for 10 years for this magic opportunity, and then there's nothing there to take advantage of. And then you're going to feel like a real idiot. So the volume of properties being built is record low and the gap is widening. There's no solution for this. Investor lending is a reflection of this. People are trying to refinance to get better rates, but it's getting difficult. And we're just waiting for the rate cuts, pardon me, to kick in mid this year and late this year before people will be able to refinance and get better rates and more competitive rates. First home buyer finance, not really relevant to what we're doing because we're kind of investors. It is getting harder and harder to service debt. Properties keep running away from first home buyers in terms of price points. I mean, the latest inflation figures and escalation in material costs and building costs and everything else didn't help the matter at all. And there's nothing that the government can do to solve that because wages have stagnated for the last 10 years and, property prices have gone through the roof. And so people are moving out to regional Queensland, Ipswich, the Sunshine Coast, from Melbourne, Sydney, and Brisbane, in search of cheaper and more affordable dwelling and lifestyle. I don't blame them. Housing credit is still going strong in terms of where we are, but it's getting harder to lend as well. And in terms of um, variable rates, most people are sticking to variable rates. You can see there you've got fixed rates greater than 3 years. You'd be crazy to fix anything at the moment because you'd be overpaying. Variable is probably the way to go. Remember, 80% of people who go variable are better off had they fixed the market. Now, into where we hit the bottom of the market, and I'll show you exactly when. If you go back to my YouTube videos, I was telling people at 2.5, 2.7, guys, fixed for 10 years because when you come out of the fixed rate, your property value would have doubled and you'll be well and truly cash flow positive. But beyond that, I've never really ever recommended fixing rates or doing half fix, half variable. I'd rather have variable all the way, give me flexibility. You can refinance easier. You're not trapped in the property. There's no penalties, no break costs. It's all about flexibility. Now, if you want to get the most competitive rate, what you should be doing every 3 to 6 months is asking yourself the question and your broker, is this the best product that I'm currently holding? Can I get something more competitive and refinance? Every 6 to 12 months, you should be refinancing as long as it's justifiable, as long as you're getting more value for money. In terms of mortgage originations for riskier types of lending, continue to trend lower in September quarter 23. So you can see that in terms of and this is to do with how many people are going through non-conforming sector. So that's been reduced because people are going uh, doing it really tough, especially lowest income earners, which tend to be attracted to the non-conforming sector. So they tend to be the ones that are getting rejected, and they're virtually, like I mentioned before, a lot of my clients can't even remortgage. They're not even in the lowest income bands; they're in the mid-income bands. But because their mortgages have doubled and life is expensive, they literally cannot even remortgage if they wanted to, which is very unusual. And I've never seen that before. Um, so in terms of calendar year growth values versus rent, annual growth in home prices have seen ups and downs in the past few years, while rents has increased at more than 8% for 3 years straight, which is unheard of, right? And so what we're seeing is vendors and landlords like myself are laughing all the way to the bank because everything's cash flow positive, and the increases that have happened in interest rates are getting offset by the increases in the recent increases in rentals. This is why I always say, guys, you've got to buy as soon as you can. You cannot wait for the market to move. Otherwise, you're going to miss out on the opportunity. This is the RBA cash rate for December, and you can see that the lowest point was in December 21. And if you watch my videos, this is kind of when I was really telling people to lock in rates for 5 and 10 years. I'm not sure if you know, but you can get wholesale rates with banks. Normally, the maximum you can fix is for 5 years. We can get 10-year fixed rates by going to the private banking sector of the bank, or going to the wholesale sector. So yeah, this is like at the bottom you can fix, but picking the bottom is very difficult. I mean, when it reached virtually zero or 0.1, I was pretty sure that was the bottom because we won't go negative in Australia. It's just not part of the banking system. So now we're back up to 4.3. Is it worth fixing now? No, I believe 4.35, which means the variable rate 6.35 or 6.25. So the bank swap rate is basically what the banks pay to settle their accounts at the end of the day, with the overnight money markets that are which are governed by the RBA, and the variable rate is about 2 percentage points or two, above that. So that's roughly what it is. There is no actual variable rate. Every bank sets their own, and there's various products. You have no-frill products, and you have products that have bells and whistles. But long term, I think we're at the peak, and we're going to go down in the future. Definitely, I think we're going to see rate cuts now that inflation is 4.1, which is still above the kind of the 2 to 3% that the RBA wants to see. You're going to see rate cuts in June, July, September, October this year. I wouldn't be surprised if we get variable rate will go from 6.25 down to 5.5, maybe mid this year to late this year, and I wouldn't be surprised next year if it goes down even further. Because remember, monetary policy is a very blunt tool. It's like putting a handbrake on the car. It's going to spin out of control a little bit, and eventually it's going to slow and come to a halt. And that's what we're doing with the economy. So long term, I think we're at the peak, and I think we're looking really good. I think in 2 years' time, we'll be looking back, and people won't believe how much they've been paying for their mortgages in the current environment. So very interesting. This is also to do with a chart showing you the rental yields, which I mentioned before. So it's just crazy what's happening with houses and apartments for Melbourne. I mean, 11.1%, and then you've got either 11.6 for apartments. Huge. Economic fundamentals. One of the biggest things that we have is population change. Is a big issue. You can see that the blue line represents completions and the red line is population change. The deficit between the two, which is in hundreds of thousands of dwellings, is the cumulative effect of the deficit that is created in the housing market as a result of getting all the migrants in. So, 320,000, and we've got 620,000 demand. We're about 300,000 dwellings behind every year. How are we going to catch up? I mean, to build 300,000 dwelling, guys, it's insanity. So in the 22 to 23 financial year, Australia's population grew by a record of 624,000, only against 174,000 dwelling completions. While population growth is expected to be moderate, around 500,000 moderate in 24, the second highest level in history. The forward-looking indicator also points to a further slowing of dwelling construction, which means the shortfall in housing will continue to worsen. Annual growing dwelling approval fell in October to only 164,000. It's huge. It's huge. The gap is just massive. So there's nothing the Labor government is doing to address this. Building government housing is a disaster. They can't build anything. It's always over budget over time. And I wouldn't be excited about that as any. No one's to live in the areas that they'll be suggesting anyway. So, this is the problem. And look at the projections of population growth in Victoria. In 2018, 6.5 million. Now by 2056, 11.2 million. I mean, it is huge. Melbourne is going to go from 5 million to 9 million by 2056. Where are we going to put everyone? And remember, the eastern suburbs in Melbourne are geographically landlocked because you have the Dandenong Ranges, which you have mountains and you've got forests that can't be redeveloped. So there's pressure geographically in the southeast eastern area of Melbourne, and the Bayside also. It's very difficult to develop there because you have large, expensive dwellings built there, and you have restrictions on footprints for townhouses. So in terms of growth, and if you look at in contrast to regional Victoria is only projected to grow from 1.5 million in 2018 to 2.2 million by 2056. So where do you think the money will be? People ask me, should I invest in regional towns? Look, invest anywhere you can make money, but I mean, but it comes down to your specialized knowledge. And Bendigo, Ballarat, Shepparton, they're great towns, but let me tell you, there's nothing compared to Melbourne. I mean, it's just supply and demand. The jobs are here, and this is why people continue to flock to Melbourne. Schools, jobs, infrastructure, shopping, culture, etc., etc. So get a part of Melbourne, guys. You won't go wrong. And this is this is interesting because this is 6.5 million in 2018 plus. You've got 2.9 million from overseas, 3.8 million births, then you got minus 2.2 million deaths, plus interstate movement equals 11.2 million population in 2056. Crazy, guys. So 32 years from now, it's going to be all over. I'll be in my 70s. You'll never hear from me after that. Actually, I'll be on my YouTube channel. I told you, people. Now everything's 20 million. I was telling you to buy for 1 million, and that's 20. And stranger things have happened, guys. So one of the problems is net migration. It is through the roof, and it is unprecedented. And the Labor Party just keeps him. Now, do we need them? Yes, we need skilled migrants. I'm a migrant, guys. I came from Poland. My mother is a migrant. She's a chemical engineer with a master's degree in chemical engineering. Came from Eastern Europe. We escaped communism. I'm all for migration. But I think we should, instead of just opening up the gates, allowing all these people to come in with no real solution for infrastructure, roads, hospitals, we need to restrict the volume, build the infrastructure, and then get the people in so they can enjoy their time in Australia, so they don't feel like they're trapped in the car for an hour and a half to 2 hours every day going to city, and there's no hospitals or where they are, there's no real infrastructure, no childcare facilities. We've got to build all those things and then bring the people in, not bring people in and hoping they'll just sort themselves out, because they don't. If you look at the volume of sales, the most expensive, 5 sales in Victoria for December, 20 Shakespeare Grove Hawthorn, 41 million. People ring me and they think $1 million is something in Melbourne. They think $1 million 10 years ago was okay. Clayton townhouses, and Clayton's like the arse end of Melbourne, are selling for 1.2 million for 3 bedders. I mean, what's $1 million now in Melbourne, guys? Nothing. And people ring me for 600,000. They're thinking they're going to get something. So 33 million in Toorak, 29.5 in Toorak, Brighton 24, and then Toorak 23. See, I remember when Toorak was 5 million for a good house, Brighton was 3, Hawthorn was kind of 4. Now, guys, just so you understand, for a trophy home in Toorak, you need 25 to 30 million now. I know this is a shock to some of you. A trophy home in Brighton now is $20 million, not 2, 3, 5, 20 million dollars. And then historic mansions are selling for 40, 50, 60 million. So what do you think is going to happen to suburbs surrounding those areas? Because remember, they're going to lift up the other areas, but depending on how relevant they are. So this is the most expensive suburb, in terms of sales for units and houses. You can see that for units for apartments, Balmoral, Maui, Bowen, BlackRock, etc. And then you have for houses, it's usually it's either coastal towns that have city views with water views, or you have the usual Toorak, Kew, etc. The most affordable suburbs in Melbourne by median price, the cheapest, Melton, Melton South, Coolaroo, Dallas, Chicana, Campbellfield, Kurrajong, Broadmeadows, Melton West, Meadow Heights. 500,000. Is it worth investing there? Do you know the problem with investing there, guys, is it's if you get look, number one is get a big block of land if you're going to buy there. Um, the problem is the tenants. Why the hell would you ever rent in Melton? I mean, there has to be something wrong with you if you're unless you got a family and a job there. Why would you just put yourself in that situation? Living is fine, but renting, we can rent anywhere. There's another 100 suburbs that are better. I often wonder about that. Well, why would you rent in Melton if you had a choice? Unless it's job related, I get it. If you're working in Melton and you got your family in Melton, cool. The problem with those areas is if you're renting a property, damage to your property is a huge risk because you can rent a 4x2 in Melton, house and land for $450. So remember, those people, not all of them, I'm not saying everyone in Melton's bad. I'm just saying statistical probability, the cheapest areas have the highest damaged postcodes. This is government data and insurance data, guys. I'm not making stuff up. I don't care that people damaging houses in Melton. I'm just saying, as an investor, you got to be aware of this because there's a real risk that you're going to get this property destroyed and the bond that they've paid won't even come close to paying anything. And then going through insurance is a nightmare. If you've been through insurance claims, it takes months and months. So in the interim, you're stressed, your property is destroyed. To me, I would rather buy something smaller in a blue chip area and do screening the client correctly to avoid the situations that you can see in Melton, Melton South, Dallas, and all these areas. Um, so strongest growth in 12 months for 23. You can see the Murrumbeena, 13.2%, Mount Waverley, 11.1%, Plenty, 10.9%, Mont Albert, 10.8%, Glen Waverley, 10.8%, Wantirna, 10.4%, Chelsea Heights, 10.3%, Croydon South, 10.2%, Wantirna South, 10.2%, and Wills Hill. It's interesting because they're not the top end suburbs, they're kind of the middle suburbs, the bridesmaid suburbs, they call them, that are attached to a growth suburb and they're going to getting pulled up now because the other suburbs boomed 12 months ago. In fact, if you come to my fast track weekend, I'll show you which suburbs I think will boom this year because they're very different from the suburbs that boomed last time. And that's it. So we're in the property cycle. Remember, there's a property cycle. Australia's very cyclical. We have the peak of the market, decline, bottom, and the growth phase. Melbourne's at the bottom of the cycle, which is 6 o'clock, from according to Harry Todd White's valuers, December. So from 6 to 9, you have single-digit growth usually, 6, 7, 8%, and this is combined suburbs from Melbourne. Then from 9 to 12, you have frantic feeding growth. You've got double-digit growth. We have 10, 15, even 20, 25%, depending on the suburb growth. Like Richmond, for example, Port Melbourne will definitely do 25% between 9 and 10. Hawthorn, Canterbury, Camberwell, Surrey Hills, Blackrock, all these kind of upmarket suburbs, they'll peak. South Yarra, definitely for houses. Mont Albert North, Toorak, they'll do really well. And so, but trying to get into the market between 9 and 12 is impossible. Well, it's possible you're going to be overpaying for everything. So my advice is you're going to buy based on the fundamentals when the market's subdued. And then when the market booms, you're just going to look really, really smart. So when are we going to hit 9 o'clock? The question is, I think next year, mid next year to late next year. And then we're going to start in 26, you're going to see growth between 9 and 12 potentially. I think it's just around the corner now. Does it matter if I'm 6 to 12 months off? No, because I've already got my properties waiting. And when next time when they do grow, it's let me tell you, it's gonna be a very interesting situation. The amount of equity they'll be making, very interesting. My advice is don't time the market. It's time in the market that matters. Dollar cost averaging. I know it's old school and boring, guys, but it always works. Buy as often as you can, as much as you can, based on core fundamentals, which never change. And then when the market goes up, you're just gonna look really smart. And then people say, oh, you could never do that again. Gee, you were lucky you bought that. Yeah, the amount of times I've heard that over 25 years, my God, if I had a dollar for every time someone said that. So, timing the market is a form of gambling to me. It's wishful thinking, and technical analysis doesn't work. So you got to do fundamental analysis, and then you just got to stick to your guns, buy the best quality product you can buy that you can afford to buy, and then hold it long term, never sell it. It's buy and hold, never sell. Yes, the best time always in Melbourne was in February, not 2019, in February 21, in February 23, when the market was at the bottom, just turning. Absolutely agree. But so what? Can you pick the bottom every time? You know, now is the second best time to buy. It's always nice to buy at the bottom, but what if you get to the bottom and there's no good stock on the market, or you can't borrow money, or the interest rates have tripled and doubled? That's the thing, guys. No one talks about this. This timing of the market, to me, it's just wishful thinking. And I've never met anyone wealthy that times the market. I've never met someone, you know what, Conrad? I always buy at the bottom, and I've got 20 properties. It's always, I've got two properties, but I'm going to buy at the bottom. And I never see them succeed. It's a form of gambling. So, to me, it's unsustainable. It doesn't work. Even if you get there at the bottom, it doesn't mean the conditions are right for buying. It's a bit of a opportunity cost of, it's like powerlifting. You build your body in the winter, not 3 weeks before summer, this is the thing. You just go to the gym every 5 days a week for years, and then you get the results. It's the same thing with building a portfolio. You build it during the quiet periods of the cycle. When it's boring, when no one talks about property, when property's going sideways or back, and the media is telling you it's going to be crashing. That's when you keep buying the fundamental areas: Elwood, Port Melbourne, Richmond, Yarraville, Williamstown, and Moonee Ponds, Essendon. And when he comes back, you're so lucky you got it for that price. Yeah. Yes, of course. It's all, guys, there's no skill involved. It's just luck. We're just all lucky investors. I hope you enjoy that summary. So the summary is, guys, it's not important for you to understand property cycles, because at the end of the day, I don't think it has anything to do with success. Success is based on the principle of consistent performance. That's all it is. It's consistency over a period of time. It's like going to gym. It's not going to gym once a month and then smashing it for 8 hours. It's going 5 times a week. Some days are shit and you don't want to train, and you've dragged your ass to the gym and there's no one there and it's raining and you could have been home, but you keep going and going and doing it over and over and over, and you accumulate all those results over a period of time, and then suddenly bang, you're strong. It's not about timing those magic moments. If I'm 47 now, and I do powerlifting and training 6 days a week, and I've put my weights right down because I don't do any ego lifting anymore. I don't get injury and I have a freaking war story like, oh yeah, I used to train when I was 20 and I did my back. I've never had an injury, knock on wood. So I'm actually getting my weights down because I want to consistently train. But do you know how many times, like, I haven't got the energy that I have of a 20-year-old? I can feel it. So do you know, if I had to make an excuse and say I'm only going to go when I feel fantastic, when I'm carved up and I feel calm, I'll probably train once a month, you know? So yeah, it's property investing is the same. You buy properties when it's hard to get finance, when you're getting rejected, when the market's on the brink of collapse again because there's some war somewhere. There's always going to be a war somewhere. Russia's always going to be doing something. There's always going to be some American guy coming over saying how the market's crashing. It takes too long to make money out of real estate. And then again, he doubles again. So to me, it's about that consistency and just putting the blinkers on and sticking to the fundamentals. That's the best advice I can give you. If you're interested in learning more, a couple of things, guys, I want to mention before we wrap up this video. Number one is I'm running my live events again in Melbourne in my office here in St Kilda. So you're welcome to attend the Real Estate Investing Fast Track Weekend. Tickets do sell out very quickly. We are running a number of these live events throughout the year. The tickets are $47 for general admittance. You can upgrade to VIP if you like. You get a copy of my book as well, Australian Real Estate Investing Made Simple, which I'm happy to autograph as long as I don't see it sold on eBay the next day. This is some of the things that I'll cover at the event, and I really unpack the whole thing from a very practical perspective. And it's actually three people. It's myself, Cameron Fisher from Changing Places Real Estate, who's a valuer originally, and he's been in real estate for 45 years. And then Stephen McClutchy from Loans Australia, who's settled over $1 billion in lending. He's a bit of a legend in the industry. So we're going to do Saturday and Sunday. Saturday is a lot about finance. I would say 60% of Saturday is finance and psychology and structuring. And then the rest is methodology, due diligence, and research. We're going to go through state by state, definitely cycles. We're going to go start off macro level, state by state, what's happening, what are the driving factors, where are the opportunities, right down to what type of properties you should be targeting, i.e. townhouse, old, new, house, detached, duplexes, apartments, what properties work, what don't, how to structure them, where to buy them, and then right down to micro level, which suburbs are booming, which suburbs are going to boom, and which suburbs have had growth already, and they're at the peak of the growth cycle. There's a lot of good suburbs in Melbourne now. I wouldn't recommend buying. I did recommend them a few years ago, and they had their run, but then they've stopped. So if you buy in those suburbs, you probably get very minimum capital growth, but maybe two suburbs next to them, there's amazing opportunities to get that growth in the next 2 years. And remember, you want to get that growth as soon as possible because you want the equity from that to buy another property. We're also going to talk about DSR ratios, which is serviceability ratios, 18 ways to supercharge your borrowing capacity, 19 questions to ask your mortgage broker, the 12 most common and deadly property finance mistakes, how to avoid them, and also the importance of balancing your property portfolio between cash flow positive and cash flow negative properties, and plus much, much more. And I'm going to throw in a bunch of really bad jokes as well. So I welcome you to attend. Tickets are $47. There's only a bunch of these that are running throughout 24. And yeah, it's a great event. We've had amazing feedback. There's many people that have attended this event, and on the back of that event have left and started massive property portfolios, and even not including clients that have never used our services. Literally, they just come in, learn the information, and do their own thing. And then years later, get an email saying, Konrad, I've bought 7 properties using your system in Sydney or in Adelaide or in Perth or wherever. Thank you very much. And this is what I've done. And we have a chat. It's amazing. So, you know, the last 10 years that I've been running these events, nearly 10 years, it's changed the lives of thousands of people. And I'm very proud of this event. And I've always tinkered with the information to give you exactly what you need to make an educated financial decision, and I stripped everything back to its essential. There's not much wasted time in these events. I get straight to the point, tell exactly what to buy, where to buy, for how much, in what structure, and why. Now, for those of you who can't make it to Melbourne, I understand there's people listening to this YouTube video all around the world, interstate. I encourage you to access my free home study, no questions asked, no strings attached. It's a recording of the Fast Track Weekend from a few years ago. You can just scroll below this video. There's a link there. Click on the link. You can access this information immediately. Now, the information's 2 years old. It's still 75% current. Obviously, the market's moved since then, and that's why by listening to these updates, you get the latest update on the market, and things have changed. Interest rates have changed. Even some of the suburbs have changed, but the fundamentals of building a large property portfolio from scratch, the kind of property that can replace your income, have nothing really changed in the last 10 years. So this is very relevant for today. And this is my gift to you. I hope you enjoy it, and I hope you get massive value out of it, guys. It's absolutely free. You can pretty much click on the link. You've got to just put your name and email address, and you can watch those videos. It's 15 hours of videos, and you get a 433-page manual. It'll take you a couple of weeks to get through the information because it is edited down. And it's a bit full on. But I'll tell you now, by watching this home study online video course, you'll know more than 80% of all investors out there. It's one of the best ways to fast track your financial literacy and the level of awareness, definitely, without question. Also, if some of you will be interested in having a strategy session with me, so if you want to use my services, and all I do is source properties in Melbourne, in the top 50, 100 capital growth suburbs in Melbourne, and there's 12 gentrification suburbs. So if you want to come to me, I can definitely help you build your property portfolio. I do a free 60-minute strategy session where we take an idea, turn it into a plan, and turn it into a very, very concise action plan. Now, remember, planning is everything, guys. If you fail to plan, you plan to fail. Okay, it's that simple. No one got to 10 properties by accident. Okay, it's by specific action that is measurable, and what you measure, you can manage. That's the key. So rather than going from A to B like this, which is what most people do, they make mistakes, they buy the wrong properties, they buy Point Cook House and Land and Dockland Apartments, and then 10 years later, they don't even know why they did that, or they buy the regional town where they live and nothing's happened. They're getting 2% growth, or they wonder if this thing actually works. We'll spend an hour together. I can look at your situation, look where you are currently financially, where you want to be, and then I can show you how to bridge the gap between where you are, where you want to be. It's absolutely free, and you walk away with a personalized strategy session. And also, I'll give you not only the plan, I'll give you the clear understanding of who you need to go to, or your consultants that can help you set up your plan. What I mean by that is the mortgage broker, the accountant, the whole team will be given to you. So you can ring up these guys, right down to financial planning, wills, estate planning, testamentary trust, everything. So you walk away with a plan, and then you walk away with a group team, literally mobile numbers and email addresses and websites of people who can set this up for you. So it's not just to get you excited and then leave you alone. I can actually do the strategy session and give you all the tools that you can use to build your personal wealth. So you walk away with a real strategy, paint by the numbers system from the 1 hour session. To qualify for the session, there's a couple of things. You need to be working full time or in a business, but you've got to have at least $700,000 purchasing power. So it says an individual, you've got to be making at least 95,000 per year. As a single borrower, which means you can borrow roughly 700,000, and you need to have at least 120, 112,000 in equity available or cash savings. So, because there's nothing under 700 that I really source. There are a couple of projects I've got in Bunjura that are 640 for townhouses, but that's very rare. Normally it's 700 plus. The average that I source is about 1 million, 1.1. And I definitely go up to, a lot of properties I'm selling right now and sourcing for clients or kind of that 1.5, 1.7 mark. For a couple, you need to be at about 120,000, and the same 112,000 in cash savings or in equity available. If you qualify, if you are working in the business or as an employee, and you do have those savings, and you can, or you just get a pre-approval for 700,000 with someone, they definitely encourage you to get in contact with me. Just send me an email, conrad@investorsprime.com.au, and then we can catch up. I will give you some times that I'm available. We can catch up over Zoom, and I can go through your situation free of charge, no strings attached. For those who are serious, I would also recommend that you watch the online video calls before we catch up if you want to, because you'll learn a lot of the things that I'll be covering. And also, there's a lot of questions that you'll have that'll be answered on the video course. But you don't need to watch it. You can just go straight to the appointment and then watch the online video course if you like. That's it from me, guys. I hope you enjoyed this video. I hope you enjoyed the new format. And I'll be doing more videos this year. I'm planning to do one a week if I can. I'm planning to do a bunch of short ones as well, not just these hour-long ones. But thank you very much, guys. I hope you have success this year. I hope you smash it. This is Konrad Bobilak. See you on the inside.